Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Emerson Electric, the industrial automation giant that has raised its dividend for 48 consecutive years.
Emerson was founded in 1890 in St. Louis as a maker of electric motors and fans. Over 135 years, it evolved into a leading process control technology company.
The modern Emerson story is really a restructuring story. In 2023, it sold its climate technologies segment, which became Copeland, and completed its acquisition of AspenTech Industrial Software.
That transformation leaves Emerson with two clean platforms: intelligent devices, sensors, actuators, and valves, and software and control, which includes AspenTech and SCADA systems.
Intelligent devices is the larger segment at roughly 60% of revenue. Physical measurement and control hardware embedded inside refineries, chemical plants, and power stations.
Software and control handles the digital layer, AspenTech for process simulation and optimization, plus control systems that coordinate how these industrial facilities actually run.
The customer list reads like the backbone of global industry: oil refineries, LNG terminals, chemical complexes, pharmaceutical manufacturers, and water treatment plants on every continent.
The moat in plain terms: Emerson's instruments are embedded in critical infrastructure where removal requires a full plant shutdown. Switching costs compound over the plant's entire operational life.
AspenTech amplifies that lock-in by connecting the physical hardware to planning and scheduling software. Once a refinery runs its operations through AspenTech, the integration becomes load-bearing.
Adjusted operating margins run around 22%. Free cash flow conversion is consistently near 95%, reflecting the capital-light nature of a software-enriched industrial business.
Emerson is a dividend king. 48 consecutive years of dividend increases puts it in the exclusive club of U.S. companies that have raised their payout through multiple recessions and market cycles.
The annual dividend of roughly $2.12 represents a yield near 1.5% at current prices. For an industrial compounder, the total return profile combines income with capital appreciation.
Competitors include Honeywell and Rockwell Automation in process control, and ABB on the global stage. Emerson's differentiation is its deep focus on the oil and gas and chemical verticals.
CEO Lal Karsanbhai took over in 2021 after David Farr's long tenure. Karsanbhai spent his career inside Emerson's automation segment, giving him an operator-first perspective rather than a financial engineering background.
He has been the architect of the portfolio transformation, divesting the consumer-facing climate business and doubling down on the higher-margin, more defensible industrial automation core.
Emerson operates in over 150 countries, with more than 3,700 active patents in measurement and control. That intellectual property library is a meaningful barrier to replication by lower-cost competitors.
The energy transition represents both a risk and an opportunity. Emerson serves fossil fuel infrastructure, but the same measurement and control technology is needed inside hydrogen plants and carbon capture facilities.
With AspenTech software, 48 years of dividend growth, and deep process industry install base, Emerson is one of the most defensible names in the industrials sector.
That is the company chapter for Emerson Electric, a 135-year-old dividend king now positioned at the intersection of industrial hardware and operational software. This is Charged Alpha.
Process control moat, AspenTech lock-in, and an unbroken dividend streak. Now let's see how the quarter measured up.
Emerson Electric Q2 FY2026 EPS of 154 beat the 153 consensus by 0.7%, one of the narrowest beats in this batch. Revenue of $4.56 billion came in just under the $4.59 billion estimate. For a company with 48 consecutive years of dividend increases and a pure-play automation transformation underway, this is exactly the steady execution Emerson delivers. This is Charged Alpha. I'm Hudson.
And I'm Lana. Emerson Electric is a global industrial automation company providing measurement, control, and software solutions for oil refineries, chemical plants, power stations, and life sciences facilities. Founded in 1890, Emerson has transformed over the last 3 years, selling its climate technologies segment to a Blackstone joint venture and acquiring majority control of AspenTech, the industrial optimization software platform. The company now operates two segments, Intelligent Devices and Software and Control. Market cap is approximately $81 billion.
CEO Lal Karsanbhai has led Emerson since 2021, architecting the transformation from a diversified industrial conglomerate into a focused automation and software business. Emerson's competitive moat rests on its process industry install base, measurement and control devices embedded inside critical infrastructure where replacement requires full plant shutdowns, compounded by AspenTech's industrial simulation software layer that deepens customer lock-in.
Q2 FY2026 revenue of $4.56 billion missed the $4.59 billion estimate by 0.7%. Year over year, revenue grew 2.9% from $4.43 billion in Q2 FY2025. The modest revenue growth reflects the current environment in process industry automation, stable but not accelerating, as customers balance capital spending plans with macro uncertainty around energy prices.
Adjusted EPS of $1.54 beat the $1.53 consensus by 1 cent, a technically positive surprise in a quarter where directional confirmation mattered more than magnitude. Gross margin ran approximately 53%, reflecting Emerson's mix of hardware instruments and higher-margin AspenTech software. Operating margin was approximately 20%. The quarter confirms the transformation economics are tracking as management projected.
Intelligent Devices, the measurement and control hardware segment, generates approximately 60% of revenue and remains Emerson's foundational install base business. Customers replace Emerson instruments when plants are already shutting down for scheduled maintenance, creating natural renewal cycles. The segment's switching costs are structural rather than contractual, a decade-long competitive advantage baked into industrial infrastructure.
Software and control, driven primarily by AspenTech, generates the remaining 40% of revenue and carries higher gross margins than the hardware segment. AspenTech's industrial simulation and optimization software runs on top of Emerson's physical instruments, connecting process measurements to planning and scheduling systems. The software layer amplifies the hardware install base advantage and creates a compounding lock-in effect.
The balance sheet carries approximately $13.9 billion in total debt against $1.7 billion in cash, a net debt position of approximately $12.2 billion. That leverage reflects the AspenTech acquisition financing. Free cash flow on a trailing basis was $600 million, implying roughly 20 years of payoff at the current rate, the primary balance sheet concern for analysts modeling EMR long-term.
The dividend profile provides an important signal through the balance sheet noise. Emerson has increased its dividend for 48 consecutive years, qualifying it as a dividend king. The current annual dividend of $2.12 yields approximately 1.5%. Management maintained full-year guidance for fiscal 2026, projecting continued organic growth in the mid-single-digit range.
The analyst community's reaction to a 0.7% EPS beat and slight revenue miss is broadly neutral. The consensus was at hold before the print and is unlikely to shift significantly on results of this magnitude. The analytical focus centers on AspenTech integration progress, organic growth trajectory in intelligent devices, and the pace of deleveraging from the acquisition debt load.
The constructive analyst view positions Emerson as a beneficiary of the energy transition and AI-driven industrial automation wave. LNG expansion, refinery modernization, chemical plant digitization, and pharmaceutical manufacturing automation are multi-year capital investment cycles where Emerson's installed base and AspenTech software are directly in the demand path. Bulls see a runway of several years of mid-single-digit organic growth.
The skeptical view flags the debt load and modest growth rate. At $12.2 billion in net debt against $600 million in trailing free cash flow, Emerson's leverage is elevated for an industrial company. Analysts who model debt reduction as the primary capital allocation priority see limited room for the special capital return activities that typically lift industrial company valuations: buybacks, special dividends, or M&A.
AspenTech's integration trajectory is the key swing factor in analyst models. AspenTech went public through Emerson's backing and now operates as a majority-controlled subsidiary. The path to full consolidation and the resulting software margin contribution drives the spread between bull and bear case projections for EMR's earnings power in 2027 and beyond.
Emerson's dividend king status provides a floor for institutional ownership. Many dividend growth strategies carry EMR as a core holding based on the 48-year increase streak. That structural buying base compresses downside volatility, a reason why EMR's beta of 1.3 seems inconsistent with its fundamental stability, reflecting the industrial sector's occasional derating during macro downturns.
The bull case starts with the AI-era industrial automation cycle. As hyperscalers build data centers and manufacturers modernize for AI-enabled operations, the demand for precise process control and real-time optimization grows. Emerson's installed base at thousands of industrial facilities globally is the entry point for the digital layer that AspenTech software provides, a compounding value creation opportunity over the next decade.
The software margin expansion story is the financial bull case. AspenTech's software revenue carries gross margins well above the intelligent devices hardware segment. As the software and control segment grows as a share of total Emerson revenue, the blended gross margin profile improves. Analysts who model even modest share gain for software in the revenue mix see significant EPS upside over a 3 to 5 year horizon.
48 consecutive dividend increases is a moat in itself. The commitment to unbroken dividend growth filters Emerson's capital allocation. Management must maintain earnings power through cycles to sustain the record. That discipline historically produces a quality of earnings justifying a premium multiple for dividend growth investors who prioritize sustainability over short-term acceleration.
The bear case leads with the debt load. $12.2 billion in net debt against $600 million in trailing free cash flow is a 20-year payoff horizon at current rates. Emerson is not in financial distress, but the balance sheet severely limits flexibility. A macro downturn would force difficult choices between debt service, the dividend streak, and organic investment.
The growth rate does not justify the valuation for bears. Revenue growth of 2.9% year over year is below the broader industrial automation sector. At 4.5 times trailing sales, Emerson trades at a modest premium to peers despite being a slower growth company. Bears argue the transformation thesis is priced in ahead of earnings delivery.
The AspenTech minority overhang is a governance complexity. Emerson owns a majority stake, but not 100% of AspenTech. The path to full consolidation and the timeline for acquiring remaining minority shares creates uncertainty in analyst models. The minority interest complicates earnings per share calculations and raises questions about capital allocation priorities.
Process industry capital spending is cyclical. Emerson's customers, oil refineries, chemical plants, LNG terminals, defer automation capital spending when commodity prices are soft. While the intelligent devices segment has structural switching costs, new deployments are discretionary. A sustained oil and gas downturn would reduce new order flow even if the installed base renewal business remains stable.
Honeywell International is the primary peer. Hoan competes directly with Emerson in process automation, building management, and industrial software. Both companies are in transformation mode. Honeywell is spinning off its aerospace and automation businesses. Honeywell's gross margins are comparable. The structural question for both: can industrial automation companies command software multiples?
Rockwell Automation is the closest peer on the software-hardware integration strategy. ROK focused on factory and discrete manufacturing automation rather than Emerson's process industry emphasis. Rockwell has faced more pronounced end-market softness as manufacturers deferred automation spending through 2024 and 2025. Compared to Emerson's process industry stability, Rockwell's discrete manufacturing exposure created more earnings volatility.
ABB is the European peer comparison. ABB's electrification and automation business competes globally with both Emerson and Honeywell across process and discrete industries. ABB's restructuring has improved its margins to roughly 30% gross above Emerson's 53%, reflecting a different product mix with higher margins. ABB's European exposure also creates currency headwinds that U.S.-focused peers avoid.
On valuation, Emerson at 4.5 times trailing sales is roughly in line with Honeywell at 4 times and a premium to Rockwell at approximately 3.5 times. The premium reflects the AspenTech software layer that pure hardware automation companies lack. Analysts who model software revenue growth argue the premium is justified. Those focused on debt and modest organic growth view the multiple as unsustainable.
Emerson options activity heading into earnings was modest, reflecting the company's industrial sector category and the expectation of incremental rather than binary results. Process automation companies do not typically generate the kind of options speculation that software or biotech companies attract. Pre-earnings positioning was neutral, neither aggressive call buying nor elevated put protection.
The post-earnings options reaction was proportional to the result. Minimal. A 1-cent EPS beat and a fractional revenue miss resolved exactly as the neutral options positioning implied. A small move in either direction, followed by a rapid implied volatility collapse. Emerson is the kind of industrial name where options activity is driven more by sector macro views on manufacturing and energy capex than by individual company earnings events.
Insider activity at Emerson reflects the company's long institutional management culture. CEO Lal Karsambai has been building equity exposure since assuming the role in 2021. Scheduled planned sales from senior executives have been the primary transaction pattern. No notable open market purchases from executives in recent filings, which is typical for large-cap industrial companies where equity compensation is structured around multi-year vesting schedules.
The combined read from options and insider activity is neutral. Pre-earnings positioning was muted, the result was incrementally positive but not market-moving, and insider transactions follow standard plan structures. For Emerson, the fundamental thesis rests on the automation transformation trajectory and the dividend streak, neither of which requires options or insider confirmation to evaluate.
Emerson delivered a 1-cent EPS beat with a slight revenue miss in Q2 FY2026. The transformation from industrial conglomerate to automation software platform continues. 48 consecutive dividend increases remain intact.
The leverage is the risk and the transformation is the opportunity. $12 billion in net debt limits flexibility, but AspenTech's software margin profile and the industrial AI automation cycle give Emerson a multi-year earnings growth path if execution holds.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.